Inside the Plan with the 401k Brothers is a production of Horizon Retirement Plans, a division of Horizon Financial Group. Bill and Andy Bush are indeed brothers, but are not twins. Hello, everybody. Welcome to Inside the Plan with the 401k Brothers. I'm Brother Bill.
And I'm Brother Andy.
Andy, as you realize, as you know, on the last episode, we talked about sort of getting ready for 2024, the new contribution limits. We had a nice piece we went over there.
That was a good piece.
Yeah, the limits being set by the IRS. But we still have a little bit of time here in 2023 as we record this. And so that has us thinking, well, what are some of the things you do need to sort of look at in your financial life before the end of the year?
Yeah, to get yourself the biggest benefit out of this year and the biggest start on next year.
Yeah, so we actually had a webinar that I did a week ago.
Yep.
And it was called Your 2023 Last Chance Financial Planning Checklist. So we're going to have a PDF of the checklist in the show notes here, and also on our website that you can reference here. But it's kind of a handy-dandy resource. Get you thinking.
It's a checklist.
So I thought we would take a few minutes and go over some of the things you do need to think about as the year ends.
Yep.
So 8 different categories here: taxes, retirement, investments, insurance, milestones, health, changes, and family. And so the first category we go over is, first of all, taxes. That's a big consideration on everybody's mind.
That's exactly right. I think the big thing is thinking about, a lot of folks might think about what kind of deductions. They want to max out their deductions for the year. Mm-hmm. So obviously, some of the things you can do, you might have some time, depending on your plan, might have some time to defer a little more into your retirement plan. If you are within the limits of income, you might be able to do an IRA or a Roth on the outside.
Have it being deductible or...
Yeah, the Roth isn't deductible. Yeah, it's not. But those are some of the things you do. There's also, if you have investment accounts outside of retirement, you could consider some tax loss harvesting. And that takes a little bit of strategy and skill to do that. If you have any investments that are down for the year, they might offset some things that are up for the year.
But those type of things do have to be implemented before December 31st to count in this year. And you can, if you do have losses, you could claim, you could offset up to $3,000 of income based on the capital loss. And then you can transfer, if you had more than that, let's say you had $5,000 capital loss.
Could have 10.
Yeah, you could claim the 3 on the 2023 taxes and carry forward the remaining.
Correct.
For the next year.
Yeah. And then the other thing is, end of the year, maybe people talk about spring cleaning. Maybe it's winter cleaning of looking through your wardrobe, looking through your household to see, hey, what stuff do we not use anymore? Should we donate that and get a tax deduction for it?
Yeah.
And that's something that in our family we do every single year, just because as we've had kids growing up, they grow out of clothes.
Nate's a big old boy.
He's a big kid. He throws a heavy ball. But if you do that, you may be able to itemize your deductions, which means maybe you have a house note and you're paying interest. So you have that little sliver. You're paying up to $10,000 of state tax. You could put in that itemized section. And then any charitable contributions, as long as that is higher than the standard deduction, which is pretty big number already.
Yeah, I think when the Jobs and Tax Cut Act came into play, a lot of more folks were able just to do the standard deduction, but that doesn't mean there aren't opportunities out there, as you mentioned. The other thing to mention about the current tax rates is that, and we don't know what will happen in the next 2 years,
or 4 years
for that matter, or probably next week. But the current tax rates, if no legislative action is taken, they will sunset in 2025. And some of those brackets are a couple of percent higher, 3% higher. The 22% bracket would sunset back to the 25%. The 24% bracket sunsets back to the 28. So again, we don't know if it will go higher, but it possibly could. That's just something to file away for the future.
Yeah. And I would also, just as a disclosure, to say we're not accountants, but we would tell you to consult with your CPA or accountant to make sure that some of the information we might be given here is accurate.
So that's a little bit on taxes. On investment side, we did mention the tax loss harvesting and that kind of thing, but it's also a good time just on the investment side, just to review your asset allocation.
Yeah. And then lastly, I think the thing is gifting. If you're planning on gifting to family members, either grandkids or whatever, you've got a gifting limit each year.
The annual limit.
And
exclusion limit.
Yeah, right. And so that is supposed to include everything you give to them. Yeah. So even birthday gifts and things like that. But think about that. If you wanted to give to reduce your overall estate and gift to them, you can do that, but you need to do it before the end.
And that is $17,000 as the annual limit. Now, you could give more than that. That just means you have to file the gift tax paperwork. Correct. And you might not own taxes because you could take the lifetime exclusion on
That's
those.
Right. Yeah.
So on the investment side, it's kind of looking at that asset allocation and maybe a rebalancing effort, because we had a lot of volatility this past year. So there might be some opportunities to look at there.
Yeah, we've had a couple of conversations here recently with participants from some of the 401ks just to talk about, hey, we haven't had a conversation in maybe a couple of years about my allocation. Am I still in a good place? And so you'll want to see, what does it look like going forward? Can I maybe rebalance some stuff? We do not typically sit down with every individual. It's only those that come to us and ask the questions. We offer to review allocations just to see if they make sure that they're not taking too much risk for their age and their time horizon. Yeah. And so that's the important part there.
A couple other notes just on the investment side: review outstanding loans and mortgages, revisit income and savings needs, review dividend distributions. So on the dividend distributions, if you had a brokerage or a taxable account, just remember those dividend distributions are taxable for the most part if you receive them in cash or if you reinvest them.
That's right. Yeah, it doesn't matter whether they come into your wallet or they're reinvested, they're counted as income to you.
Yeah. So definitely look over the investment side of things. And I mentioned loans and mortgages. It's also the end of the year is a good time, if you have debt, to prioritize paying that off.
Yep.
We've mentioned some resources in previous episodes like the debt snowball, the debt avalanche worksheets that you can use. So good time to think about that.
Absolutely.
Let's just go to retirement, which we have been talking about. You mentioned maxing out 401k contributions and IRAs. If you happen to be up there and you're getting near Social Security age, though, this is a good time to look at filing strategies for that.
Yeah, no doubt. Obviously, there's a lot to consider and a lot of unknowns from when you might file. You can file as early as 62, but for folks that are born 1960 and later, 67 is their FRA, their full retirement age. But then you can also delay up to 70 years old, and you get some extra, dollars there, 8% each year after 67 up to the age of 70. And so it's just kind of considering what kind of longevity do you anticipate, and what does it look like historically in your family, and then your need, and so you kind of balance all of that to determine when should I take it. Please, feel free to call us and we can have a conversation with you to help you determine that.
Another item on here is, this would go if you're a self-employed person, is, hey, if you haven't have your own retirement plan, think about opening one.
Yeah, and that's not necessarily a calendar year-end event that you have to put it in place. You could actually wait up close to tax filing time. Do not wait until the day you're filing taxes,
of course,
because that's too late to get things going. But if you were able to do it maybe a couple weeks before tax filing time, and you said, man, I've got more income than I anticipated in 2023, and I want to shave that down some, there are options like SEP IRAs or solo 401ks that you could do that might be advantageous to you.
Worth mentioning also, if you own a company or you're in leadership in a company, you don't have a retirement plan, there are some good tax breaks, especially if your business has under 100 employees.
That's right.
Specifically, even better if it's under 50. There's some thanks to the Secure Act, there are some nice credits to be had there. So that's a little bit on the retirement end. Let's move over to the insurance category now. Is a few things to sort of look at.
Yeah, on insurance, I mean, I would say you definitely want to review. I actually ran into my insurance agent at an event this past weekend, and I was talking to him. Hey, how's everything going? He goes, man, you can imagine it's been kind of a rough year. And I was like, oh, really? Because I don't pay attention to all the insurance stuff. I pay attention to mine.
Yeah.
And he said, well, everything's going up. All the premiums have been going up, and it's been tough on people. And of course, you get a lot of as an agent, he probably gets a lot of feedback about that. And I would have anticipated unhappy feedback.
Yeah, well, and that's a product of the inflationary environment we've been in.
That's right. Yeah, and then
the cost for replacement.
Yeah, and then South Louisiana, just the closeness to hurricanes, the percentage chance that something like that happens.
Yeah.
And so some of those things, homeowners and things have gone up. But I would say also it's not just your property and casualty stuff, but also look at your life insurance.
Mm-hmm.
And we've talked before about some of the kind of the rules of thumb on how much life insurance you should have. And one of them out there is 10 to 12 times your earnings.
Mm-hmm.
And so as you are accumulating assets in your 401k and in savings and investments outside of 401k, is maybe you don't need 10 to 12 times anymore. Maybe your kids have graduated and moved on and started their own lives, and you don't have to provide if you were absent and gone off the planet, that your life insurance doesn't have to provide for their well-being any longer. It just has to provide for your spouse.
Yeah. So it's not a set it and forget it. You need to review that.
Yeah.
The other thing I would mention is, and I've gone through this every couple of years, sort of just take your insurance needs out to market, reprice it.
Yeah. Yeah, no doubt.
And you hear the word bundling a lot. Sometimes, depending on your situation, that may not be the best thing to have multiple policies. It's just a point to consider.
Yeah, and I'll say this. I've had quite a few conversations here lately with business owners about, hey, we want to protect this particular person, so kind of a key man, or conversations we just talked about retirement earlier. Well, also inside of retirement might be some supplemental executive retirement arrangements, things like that.
Yep.
That folks want to set up for their key people. That might be just a handful of them, and we can help do that. But even conversations about cash balance plans, which are defined benefit plans. And so companies they're having good years, and they're looking for more ways to incentivize their employees to stay, but also to attract the best talent.
That's right.
And so you start to see those and I'm telling you in the last...
You're telling me.
Yeah, I'm telling you, Bill Bush. I'm telling you. No, I'm telling everyone that in the last couple months, I've had quite a few conversations about, hey, can we do something, to incentivize in addition to what we're already doing that will be a benefit to this group of people?
Yeah.
And you can do that too. Okay. So that I would say you have to evaluate those things too as a business owner.
Now we move on to milestones. And so there are certain ages that this applies. Think about these things. And we'll start with 50. So in the year you turn 50, you can actually start making catch-up contributions to IRAs and those qualified retirement plans like 401k. Your plan has to allow that. Most plans do.
Yeah.
And in the case of 403Bs and 457s, there actually may be a different type of catch-up also.
Yeah, they have some different little wrinkles there. And then I think the catch-up for HSAs is 55.
Yeah, it is 55.
And so
additional 1,000.
Yeah, additional 1,000. And of course, we've talked about HSAs before. It's one of the best retirement vehicles you have, because you get a tax deduction for putting the money in. It grows tax deferred and tax free, pulling it out for medical expenses, no matter when you use that.
55 is also mentioned on here. That's where you can take a distribution from a 401k plan if you just left
without a penalty. Still paying taxes.
Only that most recent 401k plan, not a previous employer's.
Right.
59 and a half, of course, you can take distributions from IRAs without penalty. Also, a lot of 401k plans, you can do an in-service distribution.
Yeah, and I've encountered that some with folks that they want more hands-on, a stronger oversight of their actual account.
Mm-hmm.
They've had conversations with me about, hey, I'm 60 years old now. I'd like you guys to manage it on a more consistent basis than just maybe having a conversation once a year.
Gotcha. 62 to 70, we talked about Social Security already. 65 is applying for Medicare. And then 73, you have to start taking RMDs from IRAs. And if you're not working, 401ks.
Yeah.
That's relatively new thanks to the Secure Act. Anybody born between the years 51 to 59, that age is now 73.
Yeah.
By the way, if you're born in 1960 or above, the RMD age will be 75.
Yeah. And actually, it's amazing. Yeah.
All right. Health. And we've mentioned a few health things already. Open enrollment is probably about ended if it hadn't already for most employers at the time we're recording this. But one of the items on here is to review your employer's health plan. Think about high deductible plans. Andy mentioned the HSA. That's tied to a high deductible plan.
Yeah, I would just review all of those things. Make sure that it's providing the benefit that you need it to provide.
If you have a FSA, which is a flexible spending account, know the rules specific to your company. Some allow a rollover, a certain amount. I think it's up to $610 or something. They can allow, they don't have to let you roll over into the next year. And the other is a grace period. Some will allow you to spend that money in the first couple of months of the next year. So check your plan for that. But for the most part, an FSA is use it or lose it. And then the final thing is we talked about Medicare. Just if you happen to be of Medicare age, look at your options there.
Yeah. Now, the seventh piece is changes.
Oh, little David Bowie.
Yeah, that was pretty bad.
It was horrible.
Yeah, I know.
And so some things to think about here. Did you move? Did you sell an asset like your home, business, or other real estate? I mean, a lot goes into moving, right? We just did it in our office, and you've got to change addresses on everything.
And then you might refurniture a little couple things.
Yeah.
But other life events like getting married, did you lose a spouse? Things like that? Did you change jobs? And so, think about those kinds of things. I mean, obviously, there's some planning that can go around those. You can't anticipate them, but I just lost my father-in-law, and so I'm kind of helping my mother-in-law transition through that. And it's tough because she handled certain parts of the household and he handled others. And that's typically what you see is one person might handle the finances while another is kind of the operations of the house, so to speak. And so there's a transition there, not only of making sure she has the money to pay the bills that are set up on ACH and things like that, but also just that there's already an emotional trauma, and then the adjustment of learning something new, taking on that responsibility is overwhelming. And so if that happened, reach out for help, I would say. I mean, because that's something that's hard to go through by yourself.
The couple others you did mention on there are, did you get married? Did you end a marriage? And I can think of the paperwork involved in some of that. One of the things that stands out is beneficiary changes.
Oh, absolutely. Yeah.
And, you think about if you didn't change your beneficiary and now you're divorced, we've heard some horror stories there.
Yeah.
If you are married and you'd want to add your spouse, in most cases. Okay, so the final category is just family, and this is, year-end things to think about. So contributing to education accounts, like I think of the 529 plans, there's some tax deductions on the state side, on the state end of that, as long as you make those contributions by the end of the year.
And to the state program.
Right, to the state program.
Yeah,
exactly.
And there's other things, like we mentioned earlier, like cash gifts and things like that. You need to do those before the end of the year, charitable contributions. You can do those. Don't forget about, if you are taking your RMD, you can do the qualified charitable deduction or distribution. Distribution. Qualified charitable distribution, which is instead of you taking money and then giving to your charity, you can direct it directly to the charity. And so it doesn't count as income to you. So it's actually a nice little benefit.
Yeah. And that's taking an RMD.
Part of your RMD is directed to your charity.
And actually, I think there's a quirky little loophole there where they changed it to the QCD could be after 70 and a half.
They didn't change it.
It's kind of a funky little thing.
Yeah.
But it can satisfy your RMD, but then, of course, you don't take the deduction. You just,
right. Yeah, you don't get any money because it goes straight to your charity. But if you're a charitable person and you don't need all the RMD dollars to come into your pocket, it's a way for you to maybe save some taxes.
Okay, so those are the 8 categories. You'll note, if you've taken a look at the checklist, just sort of write down your thoughts as you go through these, and what next steps do you need to make. There's a place on here to say, okay, well, I need to get my insurance guy, talk to him, put his name down, or if you need a referral on some of this stuff, if you need to talk to an estate person or a tax person or a
and I would say too on all of this is, we commonly show this illustration of a human life, 100-year human life, and it's looking at little diamonds, and it's 10 rows of diamonds with 10 columns, right? So each diamond represents a human life. And the reason I'm saying this is what we're talking about right now with this checklist is very short-term planning, looking at the end of the year, what can you do? Well, guess what? If you're breathing next year, you're going to have this kind of opportunity again. And so maybe pull up over the weeds of this moment and see, well, what things not only can I do in the next 30 days or however many days when this gets released, but what can I do in the next 3 years, over the course of the next 3 years that would be beneficial, and not wait till the last month to do them, and start to create a plan towards giving, if that's what you want to do. Start to create a plan and saving and evaluating and all your insurances and things like that. And so it just thinking a little more clearly and a little more holistically of your life rather than this short moment.
Very good, Andrew. Well, that's going to wrap up this edition of Inside the Plan with the 401k Brothers. If any of this catches your mind, you want to talk to us about it, you can reach out to me at bbush@horizonfg.com.
And you can reach out to me, abush@horizonfg.com.
All right, that's going to do it. I'm Brother Bill.
And I'm Brother Andy.
We are brothers,
but not twins.
The opinions of the hosts and guests of this podcast are for general information purposes only and are not to be construed as specific advice or recommendations for any individual. You should consult with a qualified financial professional to determine what is appropriate for you. The advisors of Horizon Financial Group offer securities and advisory services through Cetera Advisors, member FINRA SIPC. Cetera Advisors is under separate ownership from any other named entity. Horizon Financial Group, 15015 Jamestown Boulevard, Suite 100, Baton Rouge, Louisiana, 70810. Advisors of Horizon are registered representatives of Cetera Advisors, a broker-dealer and registered investment advisor.